Now $100 million. I don't know why they insist on keeping me so fat, but there I am. Okay, so there's $100 million. Now let me show you $1 billion. If it was all stacked up, that's how big, about the size of your car. This is going to get ugly. This is what $1 trillion looks like. That's Fat Glenn right here. That's $1 trillion. That's how much money yesterday the Fed created out of thin air when they said, oh, let me take it out of this pocket in an IOU, you print the money and we'll put it in this pocket. This is why yesterday, in the time that I was on the air, gold shot up $50. The price of gold is up $75 in 18 hours after they announced this. Investors, the people with money, the people that know what this means, they're not stupid. They're getting out of the dollar. The dollar deflated and went down in the biggest drop. I think it's the third lowest since 1970. Look, let me explain what this means here. Let me play doctor for you, but I'm not going to talk to you like you're a third grader, all right? I am sick and tired of people not giving you the benefit of the doubt and just thinking that you can't handle anything except a partisan argument. Here's what it is. The argument, the antibiotic that we just gave ourselves, $1 trillion of money that we just manufactured. This has been tried before, but it has never, ever worked in the history of the civilized world. Never. It ends in Zimbabwe. It ends in the Weimar Republic. It ends with wheelbarrows full of money for bread. Can this time be different? I don't know. Maybe. We sure hope so now, don't we? But we've got to have the guts to make some life-changing decisions here. We have got to have our government stop spending so much money. It is time, America, to you go up peacefully and surround the Capitol and say, hey, guys, stop spending money. You're destroying the value of our dollar. Unthinkable pain is coming in the short term, but I would much rather have that. I'd much rather have a depression than a depression and a complete collapse of our monetary system and our dollar. That's what's happening.
Anyway, the next caller is Steve in Florida.
Hey, thanks for taking the call. I listened to the Mises speech that you gave. It was great. That's something I'm going to be sending to friends and family to try to get them to see the light before it's too late. I think it really encapsulates everything about what's happening now and what's happened over the last 20 years or so. I just had a quick question for you, though. It seems to me that even beyond keeping interest rates low, the Fed is going to have no choice but to monetize the majority of the planned $2 trillion deficit this year because the trade deficits just aren't big enough. Even if China and all our creditors recycle the entire trade deficit, it's only about $35 billion a month. You know, that's
look, there's no way. Plus, if you think about what Obama is saying he's doing, first of all, you know, this deficit he's saying is 1.75 trillion. I bet it'll be more like 2 trillion by the time the books are closed on the fiscal year. He's saying that I'm going to cut that in half by his last year. Well, big deal. If he cuts it in half, that means his last budget deficit will still be $1 trillion. And if you average that out, that means he's planning on adding over $5 trillion in debt over the next 4 years. $5 trillion. Now, I mean, here you have the Chinese already saying they're worried about the $1 trillion they've already loaned us. Now, if China continues to buy at the same rate, it's probably going to have to buy 2 or 3 trillion of that $5 trillion all by itself. Do you think the Chinese are looking forward to buying another $2 or $3 trillion worth of our bonds when they're already worried about losing money on the $1 trillion they have? What the Chinese are going to realize is they're going to say, you know what? It's better to lose all of this trillion. We'd be better off letting the dollar go to zero right now and just losing $1 trillion. Because if we have to finance this nonsense for another 4 years, we're going to be in a $3 trillion hole. They're better off just walking away. And they're going to figure that out because we are asking the world. You're talking about the straw that breaks the camel's back. We're dumping we're dumping every tree in the forest on this camel. We're not just going to break his back. We're going to smash it to smithereens.
But Peter, could they even fund it if they wanted to? In the past, when it was only a few $100 billion a year, they had that money coming in from all the dollars they were getting. Even if they wanted to fund this $2 trillion, they wouldn't even have the dollars to do it, would they?
Look, I don't think they can do it, and the world is going to realize that we can't pay it back. If we borrow $5 trillion over the next 5 years, how are we going to pay it back? Especially since we're just going to borrow the money and spend it. That means our economy is going to be in a $5 trillion bigger hole than it is now. We're going to be that much less productive, that much less competitive, with that much bigger a government, which there's no way. All we're going to do is borrow more. Then we're going to have to borrow another $10 trillion, then $20 trillion. Then, when is it going to end? The world, they're going to look into this problem, and it's all going to go down soon. That is one of the reasons that, I think it's so important that people not looking at the short-term volatility of the market. Doesn't matter if the dollar goes up a little bit or stocks go down. Ultimately, the dollar is going to collapse. There's nothing else. In the long run, it's worth nothing. So holding on to the dollars, it's like...
In today's Call the Wild, the Fed's $1.2 trillion prescription for reviving the economy. The central bank saying it will buy $300 billion in long-term treasuries and hundreds of billions of more in mortgage-backed securities. So will the plan work? Let's bring in Peter Schiff. He is president of Euro-Pacific Capital back in August 2006. He told Michelle Crusoe-Cabrera that we were headed for a recession. Let's listen to that call.
Why do you think that a recession is coming? Just how bad is it going to be?
I think it's going to be pretty bad, and whether it starts in 07 or 8, I think, is immaterial. And I also think it's going to last not just for quarters, but for years. See, the basic problem with the U.S. economy is we have too much consumption and borrowing and not enough production and savings.
Okay, Peter is with us. We also have Steve Leisman and Bill Seidman along. Peter, so you made the call. What do you think happens now?
Well, unfortunately, the Fed is doing everything that I feared they would do. You can't solve the very substantial structural economic problems underlying our economy by creating inflation. All we're going to do is turn this severe recession into an inflationary depression. That's all the Fed's going to do. All they have is a printing press. It doesn't create wealth. It interferes. As painful as this recession is, we need to let it run its course because it's addressing those imbalances. The Fed is preventing that from happening. Look, we're getting a taste of what's to come in the foreign exchange market. Look at what's happened to the dollar in the last 2 days.
Bill, I too am terrified of inflation at this point. It's not here now. It's coming at some point. What do you think?
I think he's exactly right. You simply can't print money and expect that you won't have inflation. They're printing money and more every day. So we're going to feel better while that money is helping us out. It's like a shot of dope. Boy, when it wears out, then you really have the problem.
That's the last thing we need is a shot of dope. Also, printing money is inflation. We have inflation right now. The result of inflation is that prices rise, and they're going to go through the roof. What the Fed might do is succeed in stopping the fall in asset prices, but only in a nominal sense. In real terms, what the Fed is doing is going to destroy the real value of our assets even more. Because even though stock prices might not fall, the cost of living is going to go through the roof.
So, Steve Leisman, okay, I essentially agree with Peter's position to some degree. What is the Fed response to sacrificing the dollar and risking a big rise of inflation? What's their response?
The Fed's response is the other side of this coin that nobody brings up, which is deflation. They are concerned about deflation. They're concerned about declining prices, which would make servicing the debts that are out there much, much more difficult, and digging our way out of this problem much, much more difficult. If you guys are truly terrified about inflation, then Ben Bernanke is doing his job.
No, he's not doing his job, Steve. We need falling prices. That's part of the cure for this. Asset prices were too high. They have to come down. And meanwhile, if you look at the CPI number that came out yesterday...
Asset prices and consumer prices, Peter, are different things.
I know, but consumer prices... But consumer prices aren't falling. Right. It would be good if they were.
They're not falling yet, but the rate of inflation...
No, they're not. They're rising. They were up 0.4%.
The rate of inflation, that's the headline number. You take out the surge we had in gasoline prices on the core level, and the rate is down. It's still positive.
You're looking in the rearview mirror. You're looking in the rearview mirror. When the
I'm sorry, Peter, I lack the foresight that you have to look ahead into the future.
I need to look ahead. How do we know that the near-term pain of not doing this would be worse than the long-term pain pain of actually doing it, the long-term pain of the inflation.
Well, you do by looking at Japan, Melissa. You know that they went through a decade where they had a deflationary problem. They didn't get the bad assets off their books, which is something they're trying to do through separate programs. And they sat there for 10 years and nothing happened to the economy. This is what Peter Schiff wishes on the U.S. economy.
Steve, that's not true. You don't understand what happened in Japan. First of all, the Japanese didn't do nothing. They interfered repeatedly. That's why it took so long to address the problems. But we're not Japan. Japan had a high savings rate. They had a good industry. They had huge trade surpluses. We're broke. Our economy is a mess. We are not going to have the experience of Japan. We're going to have something much worse.
Can we get Bill back?
Yeah, Bill Seaman, you're nodding your head, and you've indicated that you agree essentially about the dollar decline and the inflation threat. Now, the Fed's intent, Bill, is to go after the mortgage problem by getting those Treasury rates down and pulling the mortgage rates down. The other side of the coin is the money creation that Peter Schiff refers to. So, Bill, what should they have done instead? What would you have recommended instead?
Well, first let me say that I spent a lot of time in Japan during their problems. And as been pointed out, they are a very different country than we are. They had huge savings, and therefore I wouldn't use Japan as an example.